Hi, and welcome to Fridays with Vistage. I'm Lori Allen, and I am excited about our topic today. Our presenter is passionate, and the topic is a good one for all of us. Questions every CEO should ask about their financial reports. Just a reminder, you will be sent a link by midweek next week that has the slides from today's presentation as well as other terrific resources. Our presenter is well qualified to bring us this topic. Dennis Najjar is the co-founder of accountingdepartment.com. He has worked in public accounting since 1982. After graduating from Rutgers, Dennis joined Coopers & Lybrand, and in 1986, Dennis started the public accounting firm, Dennis M. Najjar CPA. His practice has an emphasis on tax planning and preparation for corporations, partnerships, and individuals. Throughout his career, Dennis has worked exclusively with small, medium, and startup businesses, giving him the knowledge and experience to oversee the accountingdepartment.com team and helping clients with strategic business planning for future success and growth. Dennis, take it away.
All right. Thank you very much, Lori. Thank you, everyone, for joining in today. I know your schedules are busy, and I'm going to make this worth your while so that you can take ownership of your financial statements again. I'd like to do a quick three-question poll to get us started so I can get a sense of the audience dynamics. So if you all would answer those three questions, we'll allow about 15 or 20 seconds for everyone, and then we'll get a good sense of who's in attendance today and what your focus is on your internal finance. While we're waiting for that to happen, one of the things that I want to just kind of set as the pretext for our presentation today is that the way you interact with your financial person, whether that be an internal bookkeeper, an internal controller, whether you're using an outsourced person or company to handle the finances, the way you interact with them is going to establish the relationship that you have with that person. Now, what does that mean? Within about 2 weeks, no more, no less, within about 2 weeks, that person or company is going to know how involved you are with your finances. They're going to own the keys to your shop if they find out that you don't ask a lot of questions, that you don't drill into the information, that you just kind of take it at face value. There has to be a level of accountability. What I want to do today is give you the tools to enable you to take control of your finances again. Not to be an expert, definitely not to be an accountant, but to enable you to ask probing questions about your financials. Now, most of the time when I speak to business owners and I ask them, what reports do they focus on, I very often get the P&L. Sometimes I get the balance sheet. I see we're having a pretty good focus on the balance sheet, and that is really encouraging. I'm thrilled to see the number of you out there who are attending today that focus in on the balance sheet as well as the P&L. In the end, here's how it works. Real simple. The accuracy of your P&L is a direct function of the accuracy of your balance sheet. This talk today, we're going to really dive into the balance sheet. That's the black sheep of the family, if you will. Most business owners, as I say, dive right into the P&L. They're looking at margins. They're looking at net income, operating expenses. They don't cast too much time on that balance sheet. But what we want to do is really focus in on the balance sheet today to show you different ways you can challenge that information to make sure that what you're looking at on the P&L is correct. In the end, the accuracy of the balance sheet is directly going to affect the accuracy of your P&L. All right, well, it looks like we've got that pretty much completed, and I'm going to get started. Okay, so we've just talked about this, and we talked about that ownership, that accountability, and that's what you should keep in mind as we walk through this today. The big picture goal I want to talk about is something very simple. The ability to see into a number is crucial to understanding its validity. We're going to walk through the different groups of accounts on the balance sheet. You're going to be able to go to your accounting staff with the right questions. I'm not trying to make you an accountant. I just want to give you the tools to challenge them, to let them know that you're looking at these reports and drilling into them. And this will create greater accountability and transparency in your financial statements and enable you to direct your attentions back to the balance sheet, to the P&L, excuse me. All right, so let's start off by looking at our current assets. And what we have here is we're going to have a before and after. We have a test company that I created, and obviously there's some mistakes. So a lot of these are real things that we've come across. We've got clients all over the country, so we've pulled different scenarios and kind of built them into this presentation today. So what we're looking at currently is our current assets, and we're going to drill into each one of these a little bit further now. So let's take a look first at our checking account. So one of the first things you want to do when you get your financials, it may sound like overkill, ask for your bank reconciliation and the actual bank statement. Whoa, why do I need to do that? Why is that important? Very important reason. Let's look at the example company here. What we can see is that this bank reconciliation has just been done, month in and month out, and somebody's not really watching the detail. We've got a couple of checks going back to May of 2014, a couple more going back to August of 2014, and then something current. We've also got a deposit that's been floating around out there since March of 2014. Your internal person, whoever that might be, this is status quo. They are not challenging what they're seeing. We implement a lot of best practices for our clients. One of the ones that we implement in this particular area is no item should be more than 60 days old. If it is, then it needs to be questioned, brought to somebody's attention for follow-up. So the drill down you want to do here is very simple. When you get your balance sheet, say, hey, can I see the bank rec? Can I see the actual statement? Bank rec will give you a clue to this. All you're looking for is something that looks old. You can challenge them on it. If they have the answer, then you know they're doing their job. If they don't, then they don't. They're not thinking. They're just mechanically processing. Now, why do I want you to get the actual statement too? Well, it's very easy today to hide fraud. There's online banking, there's tremendous exposure to that for every business that grants it to anyone to initiate transactions. And so the proof is in the pudding. The proof is what's going to show up on that statement, not what shows up on a computer-generated report inside of a financial application. So by looking at that actual statement, showing that internal or external finance person that you're spending 3-4 minutes perusing it, you're going to show them that you're going to be on the lookout for something that might not be appropriate. So when we make the corrections here to our bank account, we get the old items cleared up. We can see that we've got a much cleaner picture, and we only have one item that should remain open. Our next account on the balance sheet that I'm going to talk about is accounts receivable. And I'm sure many of you do look at, because I see a large portion of you do look at the balance sheet. One of the sub-reports I hope or expect that you are also asking for is your accounts receivable aging. And here what I want to point out, of course, right at the beginning, at the onset, we can see that the total on the balance sheet, the 362, matches our total aging of 362 on this report. But there's also another effect going on here. It's what I like to call the Christmas tree effect. Listen, numbers in accounting should be, for the most part, black. There's a couple of exceptions to that. A depreciation, for example, amortization on the balance sheet. On your equity section, if you're in a deficit, that number might be red. If you had a loss on your net income, that number might be red on the balance sheet or on the P&L. That's it. Those are the few numbers that you should expect and allowed to see as red. Now, when you drill into this report and we see that there's a number of red items, this begs questions. Now, hopefully, when you would challenge your finance person on this, they could explain these things. There might be explanations for some of them, but likely there's not. So, for example, on this example, what we see here is that a payment was received on account, wasn't applied against individual invoices, and when the day was done, resulted in an overpayment. So the question is, why was there an overpayment? Why wasn't it applied? Why is there an overpayment? When I look at this example here, we can see that there were 3 old invoices, 30, 60, 90 days, a payment received on account again, not applied against individual invoices, and of course the end result is that the ending balance is 0. Sloppy, no attention to detail. And then our last situation that comes up here is that we've got a payment just floating out there in the 30 to 60 day category with no open invoices. Might be an overpayment. The question is, what's your policy on that? Do you hold on to it? Do you treat it as a liability? Maybe it's a deposit that should be correctly reclassified to the liability section. In any case, there's a lot of different possibilities. But the end result is that's not clean. And what you're, in essence, looking at is an understated accounts receivable. And you're not only looking at understated, you're looking at a skewed aging because of the numbers not being applied correctly. So I'm going to go to the next slide. And what we're going to see is that we now have cleaned up the mess. We've applied all the payments. We do have that one overpayment. We've got to find out what that is. And then we've see that our accounts receivable actually increased from the 362 up to the 376,000. The dollar amount of the change is not significant for this presentation. I could have made these numbers with 5 more zeros on them. The point is the attention to detail, the accuracy, the understanding of those numbers. Now, I don't expect you to understand every one of these things. What I would like for you to do is to challenge the person who's doing the work. Bearing in mind, shouldn't be a lot of red on your financials. That's your first trigger to how to question things. So as you look at this and you saw those red numbers, casual conversation, please explain them to me. If you get the fumbling, then you know they don't know what's going on. They thought they could get away with not paying attention to those details. Goes back to my very first statement. That is, that person or company, if you're using an outside provider, is going to know in a very short period of time your level of involvement and interest in your finances. Next account I want to spend a few minutes on and help you understand how you can also make sure it's accurately stated on your balance sheet is your inventory. So you can see here we have a balance sheet value of $824,000, but when I look at the asset valuation report, I'm seeing about a value of about $793,000. There is a several $1,000 difference, $15,000, $20,000 difference between the detail and the total. Should never be a difference. What's causing the difference? Well, in this case, we've got a couple of things going on. Again, I see some red numbers. Red numbers pop out at me as an accountant. I'm hoping by showing you these things that you'll also look at that as your clue to question. In essence, what's happened here is we've got 2 items that have gone negative in quantity. They've sold more than they had on stock. Now, all the accounting applications will handle this slightly different. You've got some that will, prevent you from overselling items. You'll have some that will warn you but allow you to continue, and then you'll have others that will just let you do whatever you want. I don't know where you are on that scale, but that's one of the reasons why you end up with negative numbers. So questioning that, first of all, is at the level of the negative numbers. Even if there were no negative numbers, there should be an exact match between the balance sheet and the asset valuation report. Now, when we go to the corrected financial, we can see we've got exactly the right number. We've cleaned up the missing items. There was some inventory that wasn't received properly, wasn't listed in accounts payable. The goods weren't received. Obviously, you can't sell something you don't have. And we end up with a properly reconciled aging inventory asset valuation report. Another category that comes up in businesses that are really trying to run their reports on an accrual basis, keeping track of prepaid expenses and deferred revenue and accrued expenses and accrued payroll. Prepaid, it's a big item. It's an important item to making sure that your P&L is accurate. If you just allow things to hit the P&L whenever they come in, you'll never have anything meaningful to really evaluate the business on. So the use of prepaids is extremely important. Now, when I look at this prepaid report, I see these amounts on the left-hand side representing the prepaid vendors, but I also notice this number in red. Again, that's my clue. Something is awry here. Well, the number in red in this report means that, and I see to the left it says no name. What that translates into is that when the entries were made to expense, to bring from the balance sheet to the P&L, these prepaid expenses, they weren't associated with a vendor. They were just moved. And so while you're lucky here, the prepaid total does equal the detail, you have no idea how much your prepaids actually are. So we've gone in and we've cleaned it all up. We've taken that $640,000. We've put it to all the appropriate vendors in the prepaid category, and we end up with a different scenario. We're down to 4 vendors, which much more smaller numbers, but we also notice there's a difference. We started out with 248, and we're ending up with 251, almost 252. So what actually happened in there? Now again, what do you need to do? You see a red, you ask. Let's take a look at the detail. Now this is something else you can be asking for. So not only do you want to see the summary by vendor to make sure that, there isn't that sort of a craziness to the amounts owed, an inaccuracy, at least a businessman's feel to the inaccuracy on that, but you want to look at the detail. Again, I'm not looking to make you accountants, but if you ask for the detail, you can see some of these trends, and you'll be able to get a sense of what questions to ask to make sure that person is really keeping their eye on it. Now, what we have in this example is a situation where at the beginning of the March, we had a prepaid expense for some $21,000, and then we proceeded to set up a amortization of that at $35.08 a month. And that worked fine, except that, there's always some rounding that might occur. And so you can either adjust the rounding at the beginning, you can adjust the rounding at the end. In this case, that last September 30th allocation of prepaid expense for this vendor was understated by $4. Needed to just be rounded up to zero that out. But that didn't happen, which is okay. You can catch that at the review at the end of the month. But what happened next was completely not watching the ball. And that is just continue to expense that same amount routinely, not even taking into consideration now you've ended up with a negative balance. So that's the part of that difference that we saw was cleaning up, and we'll go to the next slide and we'll see that. By cleaning up that prepaid expense account and getting rid of that over amortization of the expense, we bring that balance down to zero. So again, an example, things to ask, things to look for. Similarly, we have a situation here where there was another one of the vendors showed around $300,000 worth of a bill that came in, set up an amortization schedule. In this case, it needed to be rounded. Now, these are small dollar amounts. These are not tens of millions of dollars in differences, but the numbers can be anything, and the lack of attention to detail can be anywhere. In this case, it's just a small amount of $2.42 that needs to be fixed. And so we go to the next example, and we see that when we go back and do our cleanup or our analysis of this balance sheet, we realize that we need to correct that and move it out. All right, the next group of accounts has to do with employee advances. Some people have that. And so here we've got a whole bunch of slides. Let me kind of walk you through the progression of what we're showing. So we're starting off with the balance sheet. The balance sheet shows us the $15,140. You turn around and you say to your bookkeeper, your accounting manager, hey, let me see the detail on it. I'd like to know what employees owe me $15,000 in advances. And when you get the report, you see all these high-paid football players in your team, and you notice a couple of them have red numbers again. Red is the devil. I guess it is red is the devil, huh? Well, the red numbers are the devil. And so that translates into more questions. You can see we've got two players who actually are showing that their advance was overpaid, or they paid back more than they actually owed. And then we have that whole group of payments that when they took them out, they never associated it with an advance. They just kept adding it to the account balance. So in the total, the amount is right, $15,140 on the balance sheet. The report shows $15,140, but the detail is wrong. If you look on the right-hand side under corrected, the top slide shows that we started with $15,140. When we refunded the two overpayments to Brady and Johnson, it brought the balance up to the $18,000 number. And then when you recap the report and look at the true summary of the business, of the employee advances, you can see that it just represents 3 employees. So that is an attention to detail that's easy for you to challenge and question your finance person on. All right, next group of accounts we have are commonly called intercompany accounts, or due to, due froms, or we have related entities, related party transactions, and so you set up these accounts outside of accounts receivable because they're not trade related. You want to track them separately. Sometimes they're long-term in nature in terms of getting paid back, but they are commonly referred to as due to or due from accounts. The due from accounts are an asset. That means money is owed to you from some related party. The due to is the opposite. That's a liability, something that you owe out. So when I look at my balance sheet, I see that there's $93,000. I say, hey, let's see the detail on that. And when I drill into it, I could see that the Packers and the 49ers actually reflect negative balances. Well, what does that mean? It means that they actually don't owe my test company any money, but my test company actually owes them money. So it's misclassified. It's misstating my actual assets. It's misstating my actual liabilities. So we'll make a few accounting adjustments, and if we go down to the lower right-hand side, you can see now that reflected in our due from are the original balances from the Bengals and the Rams, and that it's actually $124,000 due from those two organizations, and now our due tos include those two negative numbers, and that brings us to a total of $133,000 or $34,000. So we've got that cleanup, that more accurate presentation where we're properly stating our not only our current assets but our total assets, not only our current liabilities but our total liabilities. It's totally improving the entire picture on which you're going to be doing certain ratios when you get to that point in the analysis. So you've got to do all this to make sure that what you're making decisions on is accurate. If not, you're only fooling yourself. Well, or your bookkeeper's fooling yourself, or your accounting professional's fooling yourself. You've got to get into the detail. The devil is in the detail. Next group of accounts I want to talk about real quick, fixed assets. You think, this is stodgy old stuff, nothing too exciting can happen in fixed assets. It's the stuff I have to, buy and depreciate. What more could there be to it? Well, there's a great opportunity to misstate the values in this account and to ultimately affect your P&L. So what we have right now is we've got three fixed asset accounts. Nice way to break it out, keep it separated out by different categories of assets. But what we also see is that there's just a lump sum for accumulated depreciation. And I look a little further, I see that there's some amortizable assets that I don't see any amortization on. They're just just listed out there. So we've got a $635,000 value for the net fixed assets. If I drill into one of those accounts, and while nothing looked out of the ordinary there, right, at that moment in time, everything looked pretty good. You saw the breakout on the fixed assets. You may or may not have thought to question the depreciation, but I'm going to look at that in a second. That shouldn't stop you from actually drilling into the detail on those fixed asset accounts. When I did that, I asked for the detail. What did I find? Well, in this case, I found a total of 5 items. 3 of those seem to be properly capitalizable fixed assets, but 2 of them are, gosh, they just seem to be miscoded. I don't know, maybe it was the vendor name. When I typed in Amazon, C came up rather than, I don't know, some sort of expense account. But clearly there's no need or appropriateness to capitalizing a $32 item or a $207 item. In fact, most businesses will follow the new regulations the IRS issued last year, using a $500 threshold for capitalizing assets if you're not having an audit performed. And if you're having an audit performed by a CPA firm, then you would be allowed to take that up as high as $5,000. So clearly, under either one of those scenarios, there would be no reason to be capitalizing such small dollar amounts. It's just not necessary or worth the while to the organization. So we took it a step further, and we looked at the depreciation, even though it was one number. Took a deeper look inside that account to see what was going on, and lo and behold, we're looking at 12/31/2014, and the last depreciation entry was 2012. So someone missed the boat altogether on the 2013 depreciation, and it looks like they're recording it once a year. Not the best practice that we follow. We're advocates of recording depreciation expense, even if it's on an estimated basis each and every month. Make that P&L as accurate as possible throughout the year. But in this case, they're using the once-a-year approach, but somebody clearly missed the depreciation for 2013 and apparently hasn't gotten around to recording the depreciation for 2014 yet. Okay, well, that's easily fixable. Now, let's do it before and after. So we got on the left is what it looked like before. On the right is what we ended up with once we dove into that depreciation number and split everything up to match the different fixed asset categories. And, well, wait a minute now. Looks like we got a new problem. Looks like we've got $210,000 in depreciation on fixed assets of $201,000. So without diving in, without asking questions, without having the right amount of detail, you would have never known that you've not only didn't depreciate your assets for 2 years, but that you over-depreciated them in this example. We've also kind of isolated out the accumulated amortization for the amortized assets, so that you got a clearer picture of the total tangible assets as well as the intangible assets. Some very fundamental things that are not difficult to ask for detail on, and in and of itself, it probably will result in things getting fixed because they'll be looking at it that they may not have ever looked at it before. Security deposits is our final fixed asset, our final asset account, falls into the category of other assets. Again, similar approach. It's going to be a theme here. It's not, I hate to say it, it's not rocket science to ask the questions. It's rocket science to get it right and to keep your eye on the ball and make sure you're paying attention to all these details. But it's the same thing over and over again. If somebody's missing it in one spot, I'll pretty much bet they're missing it throughout your balance sheet. So when we look at the security deposits account, again, first question that comes to mind, can I see the detail? Give me a summary report of all the amounts that make up that $39,000. You get a report, looks good, but wait a minute. We got that negative number again, something called no name. That must mean that my security deposits are not accurately reflected. I don't owe Cogent $4,000 and Marriott $8,500 and NFL Suites $30,000. Can't be right. So go in, fix it all up, apply all of those payments to the right place, and I end up with 2 security deposits, Marriott and NFL Suites. But then I notice, well, wait a minute. I started with 39, ended up with 35. There must have been something else they found in there that made the number change by $4,000. So I say, give me the detail. Let's dive into this. So we originally had Cogent showing a $4,000 security deposit, but we know that lease had ended some time ago. And when I asked where the $4,000 security deposit was, lo and behold, it showed up. It was on the P&L. That money coming back was credited against the final lease payment. Misstated the balance sheet. Excuse me, not only misstated the balance sheet, but also misstated the P&L. I took a credit. I reduced my expenses by $4,000. Now, I don't care. Make the number $40,000 or $400,000, whatever number of zeros you have on your financials that makes you appreciate the significance of these mistakes. That's the number of zeros you want to put on it. And so it's very simple. You misstated the balance sheet, and that had a direct impact on that P&L that you've been looking at for months and months. All right, let's move on now to the liabilities section. And kind of dive in there and kind of give you some ideas of things that you could be questioning and how to approach the different accounts that make up the liability section. So we've got the snapshot, our current liabilities, starting with the AP, running all the way through some credit cards, and then we've got those due tos that we talked about when we were cleaning up the due from accounts, and then some other accrual type accounts that we'll dive into. All right, so the first thing we do is we're going to start at the top. I love starting at the top. That's what accountants do. They start at the top. They work their way down. We're not backwards people. We want to be, we're all fall in line. We just kind of walk like soldiers and drill into everything. All right, so we get into the accounts payable, and I say, give me the AP aging report. I get that summary report on the top grid, and lo and behold, there we go again. We've got a bunch of, there's my Christmas tree. I've got some payments to Chase, no bill recorded. I've got a payment from Equipment Plus that wasn't applied to the invoice in the 30 to 60-day category. There's some overpayment from Sporting Goods. There's just lots of sloppiness here. So when we tidy it all up and we find the bill from Chase and we put that in, that's off the payables. We take that $156,000, we throw it against the invoice. That completely changes the cosmetics of my aging. I no longer have such a large percentage in the 30 to 60 day. I go from $160,000 in my 30-day past due to $3,200. Makes my numbers look a lot better. And then lastly, we found the bill for the Sporting Goods company and got that cleaned up as well. But again, all of these things are leading to something very simple. your missing expenses. Red in payables means a payment with no expense to offset against it. Once you put that expense in, that expense is going to the P&L. That's what's missing in these two of these three examples. So very, very easy, if you will, to isolate and kind of identify some of the problem things. All right, let's take a look at the credit card. Now, this is a little bit different here, and this, it's actually it's not very common, but it is something that can happen. And here we show that the number on the balance sheet, if I was to go back 3 slides, you'd see that the balance sheet had a negative $65,000 showing in the credit card. And well, immediate, if you didn't really understand the difference between black and white and numbers, you might conclude differently. You might not think that it's a problem. But this is actually a very significant problem. What's the issue here? Well, the issue is, for the first couple of months in 2014, things were moving along fine. We can see a series of charges from Staples and Sherwin-Williams, followed by a payment on August 21st, and then the cycle starts over again later August, and then we've got a refund from Dell for $3,700, and then we get down to a very large purchase of $31,000, and that brought us to a pretty good-sized balance. Then we turn around and we pay that balance off. For the most part, there's some small balance remaining, but that's where it about ends. After that, there's a couple of purchases, and then there's these two large payments. A payment on looks like the cycle ends around the 18th, or the payment's due around the 18th of the month, so the November payment is made, followed by the December payment. But all the charges are missing. Nobody's put in the statement. Probably in the rush to make sure the payment wasn't late, it was made with the idea of I'll come back later and put in all the credit card charges. Didn't happen. You may or may not be realistic in your situation, but it's something that could happen. So you would follow the same logic here. We see this negative red number. That would be your first clue there's a question. From there, you would want to follow the same approach that we talked about with the bank account. You're going to want to ask for the reconciliation. You're going to want to ask for the statement. These are best practices that every business should be employing. Again, it might seem like simple stuff, but those are the kinds of things that will enable you to know what's going on and also give the appearance, if nothing else, that you're watching what's going on with that, with the actual statements that are hitting the credit card. So when we drilled into the actual reconciliation, we found some very similar situations. We had, this is December 3rd, the December statement. We see that there's a charge that goes all the way back to March of the prior year that never, quote unquote, cleared. We've got 2 payments, both in August. One looks like a credit for something that was returned, and the other was a payment that never cleared. And those things are just not possible with credit cards. I mean, you either have it, you've either bought something or you haven't. More than likely, that $100 charge was a situation where it was recorded twice. It got cleared once, and the second time it just sat out there because of that lack of attention. It might be something very similar with that credit from Amazon. Got recorded twice, got cleared once. I mean, if you're doing the reconciliation, you had to have cleared it. And that's what this report is showing, is that it was reconciled. It's just not cleared off. The payment one is a little disconcerting because, if we were to go back, we might see that that was one of the open items on this bank account. Could have been something they paid through the other bank account. But it's old. This is December. We got an uncleared payment that's floating out there. So obviously that's a concern as well. Once we cleared all that stuff off, what we find is generally there's nothing outstanding on a credit card reconciliation except for future charges, stuff that came in after the statement closed. But as far as historical activity that's uncleared, it shouldn't really be there. Simple enough to ask, and it'll give you a really good insight into whether or not that person is really paying attention to those details. All right, next kind I want to talk about, we're going to skip a couple of things, because I think you're getting the idea. We're going to skip the Park National loan and the U.S. Bank. Those are loans. Loans should be reconciled like any other account, no exceptions. There's no gray in this. It's black or white. If you're going to do this balance sheet thing and you're going to do it right, you go through every account every month. And that's an easy one to do. It's an amortization schedule. You get a statement from the bank, you see how much is interest, how much is principal, you make sure it's properly allocated, and you've got it reconciled. You don't know how many times I've seen negative loan balances because they just charge the entire payment with disregard to allocating the interest to the P&L. Or vice versa. The loan balance never changes, and the entire payment goes to the balance sheet. So you know your loans. You know if they're amortizing loans or not, or interest-only loans. Those are easy enough things to ask for. A more important item to focus in on, I mean, really a potentially big problem, is payroll taxes or sales tax. We don't have a sales tax example here, but it's going to be the same theory that I'm going to go through right now. Now, you can see on the left-hand side, we have this catch-all account called Payroll Liabilities. Now, many of you are probably using payroll services. Many of you might be doing, or some of you might be doing payroll internally through your accounting application. My best practice is it doesn't matter whether you're using a payroll company or you're doing it internally. More so if you're doing it internally, but I still believe that if you're using a payroll service, you don't want to have one account that captures all your liabilities. This tells me nothing. When I look at a balance sheet and I see $25,000, I have no point of reference for that number. I can ask for a detail report, but I'm not going to get anything that's going to be meaningful because it's just going to be a whole list of transactions, things going in and out and in and out. There's not going to be any way to sort that. And I'm a professional, and I wouldn't want to look at it that way. That's going to mean even less to somebody like you. So what do we need to do? This is what we do. This is our best practice, right? So what we do is we break it all up. Look on the right-hand side. You can see we have that same group called Payroll Liabilities, but we break the taxes down into bite sizes. What's the most appropriate bite size? The most appropriate bite size is who you owe the money to. You've got different taxes, federal taxes, you've got state taxes, you've got unemployment taxes, you've got local taxes. It's very simple. Set it up that way. If it's not being done, tell them you want it set up that way. You're going to be amazed at what you find when they take that one account and they explode it and they put all the pieces into these different accounts. You're going to find a lot of problems. There's not one time I've ever gone through somebody's balance sheet who's had something called payroll liabilities who didn't have problems in there. Now, that could be effects on your P&L. You got under or over expensed balances, floating around on your balance sheet. Or it could be situations where taxes went or underpaid. There's no way to reconcile this. It's a very simple thing to do for someone who is on top of their game. So on the right-hand side, we've broken it all up, and we've got a better perspective. Now, I don't believe I have an example. No, I don't have an example of it. But what I would do would be the same approach I would take as in many of the other accounts. Ask for the detail. Ask for the detail on the FICA. And what you should see is a series of in and outs. For the most part, businesses are paying their taxes with each payroll, especially if you're using a payroll service. Maybe if you're a smaller company and you have payroll, you might pay the float for the month. But for the most part, payroll taxes are being paid every month. It should be a very easy thing on your eye to see. You should see a liability being created, followed by a payment of that liability, followed by a liability being created, followed by payment of that liability. It should be very easy. It's like thumbing your pages through a book. It should just flow. If you don't see that, if you see these ongoing running balances, or you see some random zeros, but these balances, question it. Don't have to be an accountant. You're just letting them know, hey, this doesn't look right. Tell me why. You'll know in how they respond to you, whether or not they really know or they're blowing smoke. You just know. It's an instinct. You don't have to be an accountant to know that. Because you will have gone through all these other things with people, and with your person or your company that's handling your finances, and you'll get that sense of, do they really know what's going on, or are they really just skirting it here? So it's so important to be able to track that. Same thing would hold true for your sales tax liabilities. Whether you have multiple jurisdictions, for example, and you need to track it separately, you need to reconcile it to the payment that gets remitted to make sure that what that liability was is what you sent out the following month or quarter, whatever it might be. All right, let's take a look at a couple more counts on the liability side and give you that understanding about how you can challenge and make sure that your balance sheet is correct and ensure that P&L that you're looking at each and every month is giving you a really true picture. So we're going to take a couple of minutes. We're going to look at accrued payroll. This is going to be an easy one for you to look at, actually. Now, this is going to be an exception. So every rule has an exception, and the exception here is red, and the red here is going to be okay. Let me explain what's actually going on here. So if you're doing full accrual accounting, right, you know, you pay your payroll, it doesn't always coincide exactly with the days of the month, and you have to accrue it. You pay it in 1 month, but you have to show it as an expense in the prior month. So the accrual part is putting it on the balance sheet and the P&L for the month that it relates to, so your financials are accurate, and then the reversal of that is what happens in the following month. So I happen to run the successive months. We accrued this in December. We show the payout of the payroll in the month of January. You could do the same thing for the month of December. You should be able to, unless there's a problem, look at the November 30th balance, and you should see that play itself out or diminish itself when that first payroll is run, and you should end up with a zero balance. That's where it should be. There shouldn't be an ongoing running balance in an accrued payroll account because its purpose is to capture an expense and then reverse it the following month. Unlike in an accrued expense where you might prepay something for several months, or a prepaid expense where you might prepay something for several months, accrued expenses is an in and then an out. So in this example, we made it look pretty. We made it all work out. After the payroll was processed in the beginning of January 2015, it all zeroed itself out. So you can look prospectively or retrospectively, but that's how you can be assured that what's going on in that account is what needs to happen. Accrued expenses is going to be the exact same thing we talked about with regard to prepaid expenses. We have on the left-hand grid, we show the balance at the end of the year was $221,000. I asked for the detail report. I've got that $221,000. So in theory, it matches. But again, when I look at it, I only have one exception to my red. Number should not be red, and I've already used that up. So that means that red in this report is not good either. And so what we have is $848,000 worth of accrued expenses that have been moved back and forth between the balance sheet and the P&L, but they haven't identified them or associated them with any of these vendors. And so the balances that it reflects to each one of those is negative. So it's almost as if you owe Baltimore $197,000. I'm sorry, that they owe you $197,000, not that you owe them $197,000. It's totally backwards. So we realize that, and then we go back in and we deep dive, we do a deep cleanse, and on the top right-hand side, we got a little reconciliation put together. So we started out with a 221, but the final number is not 221. The final number is 227. This is what your person should be doing for you before you even have to ask these questions. In fact, you shouldn't even see this. What you should see is the lower right-hand side. But if you were to question it, you would well be within your rights to say, well, how did you get there? What did you change to take me from 221 to 227? And what we would find is a series of several mistakes or oversights within the detail that go beyond not applying the actual journal entries against the individual vendor balances. So in this example, and I'm just going to kind of point them out to you. So you've got the Ravens had a mistake of $1,600. You had the Browns a mistake of $383. The Giants $500, and the state of Texas had a $4,000 mistake. So something with Tennessee. When you kind of sort that all out, you realize that you were understating your accrued expenses, which, by the way, is misstating your balance sheet. You're misstating your P&L. So it's all, I may sound like I'm just going over all these things, balance sheet things, but the implication is what you should be focusing on. These mistakes are only going one other place. There's only two places things go in a financial report. Either go on the balance sheet or they go on the P&L. And what we've been figuring out here by going through this account by account, line by line, group by group, is what doesn't belong here and getting it to its proper place on the P&L so that you're looking at the right numbers. This is just a couple of, this is a detail on how you could know that those account balances are wrong. And so, again, it's easy for me to read it. Listen, I look at this and it's numbers. I can read it with my eyes closed. But, I did pretty poor in foreign language. So I'm going to relate to the non-financial person. And that's how I relate to you. Very simply. I am pretty sure when you look at some of this stuff, it's like me looking at Spanish or Chinese in a document. It just doesn't mean anything to me. It's just letters or symbols or something strung together to make words that turn into make sentences. So I empathize with it. But you need to have some ownership of this, some control over it to kind of, show that you're in charge. So that's what the objectives here were today. So when we look at this, we can see the first quarter worked out perfect for the Baltimore Ravens. We had accrued $21,529 for this licensing fee or this accrued expense, and the bill came in, zeroed out the balance. Second quarter comes along, and we've got a accrual for the same amount. For some reason we decided to change it, went down a little bit. So at the end of the period, we had $67,900, but then the bill came in, it was only $69,584. So we actually had accrued or had expensed $1,600 more than the actual bill came in. Now, that happens. What you shouldn't allow to happen is not to resolve that. So as we see in the third quarter, that difference actually continued. It actually changed again by a penny, but either way, it continued on. And then we get to the fourth quarter, and the numbers revised again. And now our net ending number is not 3 times 16,958. It's 3 times 16,958 minus the mistakes from above. So if we go to the after, what are you looking at? You're looking at fixing that $1,600 in April, fixing that penny difference in September, knowing that your ending balance, very simply, is 16,958 times 3. You can see immediately before the start of the fourth quarter that after paying the bill for the third quarter, your balance is 0. And that's what I was referring to before when I'm saying when you go through these reports, I understand it's like reading a foreign language, but look for the pattern. A lot of this is patterns. That's not going to make you an expert in it, but it'll at least give you a perspective to say, well, geez, shouldn't this be 0 like after all these events, rather than just a 0 way at the beginning of the year and then a 0 way at the end of the year or in the middle of the year or something like that? There's something happened in between that's not being accounted for correctly. It's pretty straightforward when you know what you're doing, and I'm talking about for your finance person, whoever that might be. Similarly, there's the same thing with regard to the Cleveland Browns. It's another example. This is actually the opposite. Rather than accruing enough, they didn't accrue. Rather than over accruing, they under accrued, and so now they've got this build up going the other direction. But again, you can see the pattern. You see the 0 up to the first quarter. You can see the mistake, the remaining balance in the accrued expense in the liability in the second quarter. Third quarter worked out, but that amount from the previous quarter is just still rolling right along, and it rolls right into the ending balance. This is your after picture where you can see there was an entry in there to fix that. Perfectly acceptable to fix it. That's part of the way these things work. And then after that, you can see at the end of the second quarter it's 0. After the third quarter it's 0. And if you were to add up your last 3 months, the 17,943, that would actually equate to your ending balance. So it's right back where it needs to be. All right, last topic, last account we're going to talk about is deferred revenue. It's an important account for many businesses. It's growing importance just leaps and bounds based on how we're interacting with our clients and how we bill for some of the work that we do for them, whether it's a professional service organization or some sort of contractual obligations. We're often doing quarterly or semi-annual, or in some cases annual invoicing, and you no, you're not going to recognize that all as revenue in the month you send out that invoice. It's just not going to give you anywhere near any sort of an accurate picture. So you capture all of this invoicing that has not yet been earned. Translated, that's called deferred revenue. You capture that on your balance sheet until that month or period comes where you are entitled, or you've done the work, or contractually that obligation has been fulfilled, so forth and so on. So again, such an important number. It's your top line. It's potentially a very large number. So you've got to have a handle on its accuracy. Otherwise, your whole P&L is shot. So here again, we start with the summary. We see the number on the balance sheet, $2,050,000. I ask for the summary report. What do I see? I see a whole bunch of red again. And so I say, hey, what's the $500,000? Shrug the shoulders. When I dive into it, what do I find? I find that it's the same thing. Payments were, journal entries were made to move these funds out of this account back over to the P&L where they belong, and they weren't associated with any customer. So you don't know. Do you really have $570,000 worth of services that you haven't provided to the Arizona Cardinals? Yeah, hopefully, that's the right number. But until you go in there and get all this right where it belongs, you're not going to. So on the right-hand side, we've got the cleanup of all that, and we can see that the balances are now accurately stated and will be tracked correctly going forward. You'll also notice that there's a difference. We started out with $2,050,000. We're now at $2,047,000. So something was wrong in the picture as well. So when we drill in, you should see the consistency of what I'm showing you. And here it's the same thing. We asked for a detailed report, drilled into the Arizona Cardinals, saw that we gave them an invoice for $205,000. That was for 3 months worth of licensing or for services, whatever we're doing for them. We're going to pick that up as revenue over that 3-month period, but that leaves us with a balance of $3,000. So the number shouldn't have been $67,365. It should have been $68,365. If you hadn't picked up the two pennies difference.
Dennis, this is Lori.
Yes.
Can you hear me?
I can hear you now.
This is interesting. I was going to see if you, because we're getting close to the end, if you could wrap up and then we could ask a few questions that have come in.
Sure. Well, I'm lucky for you. I'm 2 slides from the end. So it's the same approach. You can see the similar examples, and you're just drilling into the detail. That's our last account. I'm going to skip that because that shows the after. And then the summary, the last couple of pages, is just going to give you the comparison between the before and after, so you can kind of get a sense of what you'd want it to look like if you were diving into your own balance sheet and asking these questions. And that should do it, Lori.
Well, great. We've got a couple of questions, Dennis, about projections. The first one is, what's the best way to project the revenue?
Well, you have to look at your business model and understand what's going to drive those revenues. There's not going to be one answer to that question. Depending on how you want to make assumptions on what your revenue growth is going to look like. Are you in the growth mode? Are you in the maintaining mode? Are you going to get more clients paying up front? There's a lot of variables that go into that. So you have to really kind of dive into what your business model looks like in terms of how you're going to structure your revenue.
And what's a good resource for cross-referencing projections?
Cross-referencing projections. Anything more than that?
Yeah, I can kind of dig into that. If you want to maybe talk about your favorite books. No,
I was just going to say that's the extent of the question on that one. Because it's not really...
Yes, there is a little bit more. Cross-referencing or validating. And this person who writes, he or she says, I would like to check for omissions and under projections.
Well, that would be comparing it to actual. So your forecast is what you expect to happen, and then you're going to have what we call a rolling forecast where you're backfilling it with actual, and you should be comparing it against what you forecasted to see if you're living up to your forecast. If not, that's going to have a ripple effect on the future months, because the forecast is kind of a living document. It's not just a static event in time. It's intended to capture what's happening now with an expectation of where things are going to go. It's kind of like a snowball. The snowball just doesn't disappear after that first month. It continues to move on, and it's either going to follow the same path that you've put out in terms of the prediction, or you're going to go above or below. So monitoring it against actual is probably the answer to that question.
Okay. Another question, what are key performance indicators regarding financial reports?
Well, it depends on whether you're talking about the balance sheet or the P&L. My favorite one on the P&L is going to be gross margin. One of the first things that I like to take a look at on any set of financials is the chart of accounts accurately laid out on the P&L. Businesses will live and die by gross margin. People like to talk about net income. Net income is important, but gross margin is where it all starts, in my personal opinion, in my professional opinion. And so having a properly laid out chart of accounts, making sure that you capture all the costs that go into either the product or the service that you're delivering will ensure that you're really getting an accurate picture of what your gross margin is. Because gross margin is what's left over to pay G&A expenses, to pay sales expenses, and to have that bottom line profit. So the first one that I want to focus in on with clients and prospective clients is, do you really have a good handle? I'll often ask, what margin are you working on? And the business owner will have that kind of gut feel. Well, this is what I'm getting. Well, do you have anything to back that up? Because when I look at your financials, it seems to be missing some of the key elements in your cost of services or cost of sales section. And then once we kind of rearrange the chart of accounts, it's sometimes eye-opening for them.
I think we have time for one last question, Dennis, and it's from Timothy, who says, can you address the issue where you might be paying a monthly health insurance invoice, but you are collecting premiums bi-weekly through payroll deductions?
Yep, I would set that up as a liability on the balance sheet so that you're properly tracking it separate. And a lot of organizations will charge the full bill to the P&L, and then they will apply the payroll deductions to the same place. It doesn't give you a way to really keep track of if you've gotten all the amounts due from the employees. So whatever percentage that is that belongs to them, you're better tracking it on the balance sheet, or from them, I should say.
Dennis, thanks so much. And if people have some questions and want to get in touch with you, can they find you at accountingdepartment.com?
That's where they'll find me. We're a virtual company, so I'm not any place physically. I'm everywhere, if you will.
Well, great. Well, thank you so much for being with us today. And before we go, I want to tell you about next time's Fridays with Vistage webinar. The speaker will be Mark Taylor, and listen to this topic, tribal leadership, because culture eats strategy for breakfast. You will learn how to increase production 3 to 5 times, how to hire the ideal talent for your team, and how to achieve things you never thought you could accomplish. And Mark is a Vistage chair and a Vistage member. Well, for all of us here at Vistage, thanks for participating today, and have a great weekend.